Lights, camera, action, stories with Zach. I ask the questions and you get the answers. This week, I sat down with Greg Eickmeier, an advisor at CIBC Wood Gundy, to discuss the impacts of COVID-19 on investing and retirement savings and planning. So, thank you very much for joining me today. I really appreciate your time. So, how generally has COVID-19 impacted people's finances and investing?
Yeah, that's an interesting question. It's been a big change over the year. Back in February and March, stock markets, just major stock markets around the world, dropped by 30 to 40%. So obviously that had an impact on client investments. The interesting thing, when markets dropped that much before, and I think the last time they did that was during the financial crisis back in 2007, 8, 9. The difference being, at that time, it took about a year and a half to drop 30 to 40%. Last year, it happened in about a month. But it was kind of, I guess, a quick realization. Markets don't like uncertainty, and the uncertainty that arose from the pandemic, didn't know how bad it was going to be, how long it was going to last. There was always going to be an end in sight with vaccine and getting it under control. It was a question of how long. But valuations of companies shouldn't drop 30 or 40% in a month's time. And for some prudent investors that looked at it as an opportunity to buy some very good companies at cheap valuations, that was a great opportunity. Some of the other things I've seen through financing and finance and investment, it was just the adoption of technology. But yeah, the adoption of technology, things like Zoom, which has been great because we've been now encouraged to avoid any personal contact with clients and investment managers, just to avoid any spread of the virus. So as a replacement for that, Zoom and Microsoft Teams have been a great replacement for that. I've seen it just in terms of client meetings. I have client meetings with all clients, in person, but that's obviously not happening. So some of the things, for security purposes, we're not allowed to. Well, I guess for security purposes, it's more secure to have a secure email going to a client that's password protected with information that you're going to cover off, rather than have a Zoom meeting or Microsoft Teams meeting where you're sharing a screen, because Microsoft and Zoom meetings can be hacked into, and then you're inadvertently sharing personal information with somebody who's getting on, hacking into that meeting. So you want to be careful with that. So technology has certainly been a big factor in that. Work from home. I've been working from home for a little bit more than a year now, and it's been seamless. In terms of work, the remote desktop, basically anything I can access at the office on my computer, I can access at home. So that's been great. And I think, some of the things that will happen in the future, that a lot of businesses may rethink their real estate. If they can have a certain percentage of people working from home, it can, reduce their real estate footprint, and basically they save that cost when their lease is renewed. I have a friend who works in marketing for a large multinational company, and basically he said that his travel and expenses are zero for this year. So they're not factoring any travel, and certainly that has its impact on airlines, restaurants, hotels, a lot of the travel. I even see it with my retired clients, that we factor in an income so that they can enjoy their retirement lifestyle, and have travel, but they obviously can't travel, now for the past year. So clients have said that, geez, we're not spending as much money. So that money is just actually going back into their savings for a time when they can travel.
Have you noticed like a general or a big shift in investment strategy as a result of COVID-19?
I haven't. Like in terms of what I've done for clients, or what I do for clients, is is more the planning. So it's upfront and kind of separating that short-term money for longer-term money. So for clients who, experience, well, for all clients and everybody who experienced that downturn in February and March, that really didn't have any impact on them for that short period of time, because we're not investing in stocks. Stocks are investments for longer term. They're not investments for next month or 2 months. So that really had no impact because of the planning. And I think that's a real important distinction, that you got to separate your short-term investments from your longer-term investments. How much money do you need now versus how much time, how much money do you need later? And there's no way that you can factor it. I guess in terms of planning, you're always kind of thinking, well, what's the worst that can happen? Because there's always going to be something that will happen that, or is just not foreseeable. 9/11 happened. You can't foresee that happening. I think the pandemic ranks up there with something that you can't foresee how, something like that is going to happen. But when they do, happen, there tends to be a knee-jerk reaction, a big impact on the markets, but shortly after that, they recover. And if you separate that short-term money for longer-term money and invest accordingly, it really doesn't have that much of an impact on it. It can be unsettling when it happens, but it really doesn't affect one's plan.
In terms of like the long-term and short-term planning, has any of the government COVID assistance programs had any effect on it?
I think those plans were helpful, like obviously for people who were affected, their jobs were affected because of COVID and businesses being affected. I know a number of businesses that took advantage of some of the government assistance that was available for businesses if their revenue was down 30% year over year. So that's been helpful in terms of maintaining that and maintaining that business continuity and paying those workers. So it certainly has been helpful in that regard.
Have you found that the low interest rate has been helpful in any way, shape, or form?
Well, certainly it's had an impact with regards to COVID and not, like, certainly from a borrowing perspective, it's certainly a lot cheaper now to borrow than it has been any time in the last 40 years. 40 years ago, you would have a mortgage rate over 20%. Now you can get it under 3%, and even lower, I think under 2% in some areas. So obviously, if somebody's borrowing, they can afford a lot more of a mortgage, which means they can afford a lot more of a home. Obviously, some of the things that you have to be aware of, that interest rates can go up, and that can cause pressure that will increase the mortgage payments. But I also see it from an investment perspective. It's interesting now, somebody with a line of credit can borrow money on a line of credit at under 3% on a home equity line of credit. If they borrow to invest in income producing securities, that borrowing cost is tax deductible. If someone is, and if you borrow to invest, you can invest in some good quality Canadian companies that are paying a 4% or higher dividend yield. So, and if your income is under $49,000, that Canadian dividend is taxed at 0%. So if you borrow to invest, you can actually make, the dividends will pay for the cost of borrowing, and then you can realize capital gains over the longer period of time. So that can be very helpful and assist some investors in that. But obviously, you have to, whether it's a mortgage or borrowing to invest, you have to be aware of the direction of interest rates. But it doesn't look like interest rates are going to be going up significantly in the next 2 or 3 years anyway.
So why should somebody get into investing or even just planning out their finances?
Yeah, well, I think it's important, like just from a retirement perspective, if you have no pension plan, and most Canadians don't, if you don't save on your own, the only sources of retirement income are going to come from the Canada Pension Plan and Old Age Security. So your maximum Canada Pension Plan is around $1,200 per month. Your Old Age Security maximum benefit is $600 per month. So the maximum that you can get from government pension at retirement, if you save nothing else, is $1,800 a month. I think I think on statistics, Canada Pension Plan, the average recipient, CPP recipient receives, I think it's $700 per month. So the average retired person in Canada receives about $1,300 from Canada Pension and Old Age Security. So, if you figure that Canada Pension Old Age Security will give you somewhere between $1,300 and $1,800 per month, if your retirement lifestyle can't be met with that income, you basically have to save on your own. And whether it's through a group plan at work or your own savings, through an RSP or a tax-free savings account, you'd have to do it on your own.
When it comes to long-term planning and in investing, is there like risk levels? Is there risk levels that people should be aware of or watch out for?
Oh yeah, I think you have to know your own risk tolerance. Like as I mentioned, February, March stock markets went down 30 to 40%. So if you're just invested in stocks, your portfolio probably went down somewhere between 30 to 40% over a very short period of time. If you don't understand your risk tolerance and have a plan and understand that there's going to be fluctuations, the worst thing that could happen to destroy one's plan is to exit because you're uncomfortable with that market volatility back in February, March. And so if you exited back at March the 23rd, you missed out on any market recovery to new highs. So, and you crystallize that loss. So one is understanding your own risk tolerance, but also understanding your longer term plan. So it's a very important thing. Every security has, every investment has different risk tolerance, but you can create that portfolio to make it or try and make it something that you're comfortable with, so you don't make an emotional decision that's going to destroy the long-term viability of your plan.
Is there an age too young to start saving for retirement?
You're never too young. Early and often is my thinking. It's just and I think the biggest thing is that you want to start as early as you can afford it. Obviously it's easier to start now, as early as you can for retirement, as opposed to start thinking about it when you're 50 years old. It's just that you have a longer time to save. It's a matter that you can control what you can control. You can control how much that you save for retirement. You might not be able to control, the inflation rate or how much your return is each and every year. But some of the things you want to focus on is controlling what you can control. And one of the things that you have 100% control over is how much you can save each month or each year for retirement.
And my final question, what are some of the benefits and some of the reasons why people may want to look into RSPs or TFSAs? Yeah,
like apart from the general, goal of saving for retirement in the case of an RSP or any other plan, whether it's supplementing your retirement or another goal for the tax-free savings accounts, that both have benefits. Kind of the difference between the two is the RSP, which is a registered retirement savings plan. It allows you to save your pre-tax income in a tax-deferred account, and then when you're retired, you take that money out. It's taxed as income, and for some people, if you can. You get the benefit of that tax deferral over a number of years from your working years to your retirement. But also if in your retirement, you're in a lower tax bracket, you're not only deferring it over a number of years, you're deferring it to a time when you're in a lower tax bracket and taking out that money. And so that's a benefit for that. It's a little bit different than a tax-free savings account, is that a tax-free savings account, you save your after-tax money into account, and then you can take that money out. That money grows compound tax-free over as long as you keep it in there. When you take it out, that money is tax-free as well. It's interesting. I did a comparison for a client on each of those over a longer period of time, and actually at the end of the day, in the top marginal tax bracket, using the calculations for that, they both, you end up pretty much equal, whether you save in an RSP or a tax-free savings account. But whether you take one or another, it depends upon your goals. But if you're fortunate enough and you can add to both, that's even better.
Awesome. Well, thank you so much for joining me. I really appreciate it. I've asked the questions and you've now got the answers. That's it for Stories with Zach. Lights, camera. Bye-bye.